Yes, go ahead.
All right, so in that case, just make sure. Right, okay, so hi Linda, thank you for being here, and please go ahead with your talk.
Thank you. So let me share my screen. Can you see the slides?
Yeah.
Okay, great. So first of all, thanks so much for inviting me to present here, and it's great to see you again, even though the circumstances are interesting, but okay. Okay, so the paper that I present today is joint work with Jesus Fernandez Villaverde, who's at University of Pennsylvania, and Harold Uhlig, who's at University of Chicago. And well, the project is about central bank digital currency. And so just to bring us all a bit on the same page, what a CBDC is, first let me say that the definition of this term is very much in flux. So there are various ways how you can interpret a CBDC, and the paper talks about a very particular kind of a CBDC. So we are drawing on the following definition by Bader and Kumhof, who refer to a CBDC as a central bank that grants universal electronic 24/7 national currency denominated and interest-bearing access to its balance sheet. And we will talk about a so-called account-based CBDC, which can be implemented via accounts that citizens hold directly at the central bank. So this is exactly the definition that we will use today. So imagine you and I, we have our bank account, and not at Bank of America maybe, but directly at a central bank. And we have access to this account at any point in time. Okay, so the research on CBDC is currently really exploding, I would say. So you can read about CBDC in the news on at least a weekly basis, because currently several policy institutions are debating the pros and cons of introducing a CBDC. So amongst others, very leading the Bank of Canada and the Sverige Riksbank, the Bank of England, but also the BIS, the ECB, the Bank of China, IMF and G30, and many, many more. So it's a very interesting topic to work at, and in various kinds of ways. So the CBDC, you can think of it as the public response to private initiatives, private digital currencies, or Libra or Diem now. Well, so the paper joins or zooms in at a very particular aspect that a CBDC is going to bring, or is going to change the economy or incentives in the economy. Namely, we are going to look at potential conflicts of interest that arise when a central bank starts offering CBDC accounts. So
I have a question, Linda. Sorry to interrupt. In the prior slide, when you list sort of all these sort of central banks studying sort of this prospect, what concretely are they thinking about, like of offering directly digital infrastructure to support it, and also to provide banking services directly to citizens, or to institutions that then provide their own services to citizens?
Yes, so that's a very good question. So I think one reason that they're addressing is to improve the efficiency of cross-border payments, because there's apparently a demand for that. It's not quite clear to me whether a central bank should offer such a service. My guess is that we have been observing that cryptocurrencies become more and more popular as an investment object, as a means of payment, and so on. And I guess central banks, as the provider of national currency, try to find an answer to that. And a way to answer to that is by offering a CBDC. Now, a CBDC, and this is exactly why I think this paper is interesting, is a CBDC is not going to be solely a means of payment, but it's going to also affect the competition in the deposit market between central banks and private banks, for instance, or it's going to affect the interest that a central bank follows through with. And so
simply because it's going to change the forces of, like, even just forex investments. Like if I want to, I don't know, if
yes.
somebody wants to change a part of their deposits into a different denomination, then it would change like how easy it is to do that and whether somebody wants to do it, and so it might affect these markets.
Yeah, so I guess the way to see it is that the central bank enters a new business and therefore is going to start competing with firms that are already in this business, like payments, for instance, or offering deposits. And this is going to change the landscape.
Okay. Thank you.
Okay, so so there are various ways how a central bank could be a game changer in a positive or a negative way. And this paper tries to address potential conflicts of interest in which a central bank could here step into. Namely, traditionally, a central bank objective would be to keep prices stable, so to target inflation at 2%. This is the case in the euro area, it's the case in the United States. But as soon as a central bank starts offering CBDC accounts where small citizens like you and I, we can basically save money in the central bank account, and then the central bank collects all these deposits and will have to, if the central bank agrees to pay an interest on these accounts, the central bank will have to earn interest also on these kinds of funds. And how do you earn interest? Well, you reinvest, and potentially in long-run investments like long-run assets, real estate infrastructure, and so on. The key point is here, the central bank becomes a so-called financial intermediator. She intermediates investment, and she conducts maturity transformation. Namely, if you and I have 24/7 access to the central bank's balance sheet, short notice, demand on short notice, but at the same time, the central bank would invest in the long run, then there's a so-called maturity mismatch. And a traditional risk that comes with maturity mismatch is the proneness of financial institutions to runs. And a classic question in financial intermediation in general is the optimal amount of interest rate that you would pay on such deposits, which we also call optimal risk sharing, but I will go into detail. So all over, there will be, in this paper, 3 competing objectives. So keeping prices stable, but also offering optimal, let's say, interest rate on deposit accounts while preventing runs on the central bank. And the key result in the paper is that we show an impossibility to combine or to attain all these 3 objectives at the same time. Namely, I think the most, so we call it the CBDC trilemma. In order to attain, you will always have to give up at least one of these goals to attain the other 2. And we believe the most important one of these is we show that the central bank could always offer optimal risk sharing and also deter runs, but only by credibly giving up the price stability objective. And that's important. Okay, so the key mechanism in the paper is traditional runs cannot occur on a central bank because a central bank can always deliver on so-called nominal obligations. The central bank can always print money. Therefore, it cannot be the case that you go to the bank and the bank says, I'm sorry, I cannot give you $100 today. There are only $10 left that we can pay you out. This is not happening with a central bank. So a central bank could always deliver on such promises. But instead we see, or we will see today, that a run on the central bank can happen in a different form, namely in form of a run on the price level. So basically exploding inflation. Okay.
So I have a question. So why is that? Why can't that happen with normal, money that they print? I mean the like dollars are still traded like on forex markets. Like if they print more money, like that will affect potentially the price of a dollar against other currencies. Like I don't understand how.
Okay.
And even if they don't print more money, it's already like fluctuating as a function of the market. So I'm trying to understand like why it's different.
Yes. Okay. So if you, let's say it's not a central bank but a private bank, a private bank can run out of assets to liquidate, and then the central bank, a private bank could no longer hand out. Okay, so.
Yeah, so that I understand for private banks, but I mean the difference between a central bank printing paper money versus printing digital money.
Oh, there would be no difference.
Okay, fine.
So far there would be no difference so far.
Okay.
Okay. You're making the comparison between
Well,
Yeah.
I was trying to say, like, the second point here, this as a central bank runs happen in the form of the price level. I mean, that's true, I guess, for both digital currencies and for paper money.
Yes.
So maybe the speed at which it happens may be different. I don't know, but like there is still money printed by the central bank, whether digitally or paper, and it still will be traded on forex markets, and so it will still be subject to those forces.
So I should maybe say this is a summary slide, and I will explain the mechanism behind this in detail.
Right.
So sorry, that's misunderstanding. So I will come to this in detail.
Okay,
I'm just
cool.
summarizing the results. Okay, so I will skip the literature for sake of time, but we will come back to this model in detail in a second. Okay, so let me walk you through the model. We are building on Diamond Diploid 1983. So this is a very a famous banking model, and it works the following way. So there are 3 time periods in which agents basically exist, and agents are given by a continuum, which basically means agents are small. And so at time 0, all agents are symmetric. Agents cannot be distinguished. And each of us agents is endowed with 1 unit of a real good, and you can think of this real good as an apple. Yeah. And we only care about apples, the consumption of apples. And so in the next time period, something happens, namely, all of a sudden the agents will not be symmetric anymore because they learn something about themselves. Namely, they learn whether they are the impatient or the patient type. And think about if you learn that you're impatient, you know that you're not going to live till the last time period, time 2, but you only live up until here, which means that you instantly have to consume. So you really don't care about consumption at time 2. And if you're a patient type instead, then you can consume at time 1 and time 2 because you will live a little bit longer. Now, crucial is that your type is private information. I cannot see whether you're impatient or patient. And there's no way to verify a type. Okay. What we all have in common is that we have a strictly increasing and concave utility function, which basically means the more apples we consume, the happier we are. And marginally, if we already have consumed a lot of apples, then if you give me an additional apple, I won't be that much happier. Okay. And so there's an investment technology that allows us to transfer apples across time. So recall at time 0, each of us is endowed with 1 unit of an apple. And we can now invest this apple in this technology. And this technology pays off the following way. For every apple that you invest at time 0, the technology returns 1 apple at the interim period 1. So this basically acts like storage. You can store your apple across time. But now between time 1 and time 2, the technology pays off a very large return. You just imagine your apple grows, becomes much, much bigger. And now Diamond and Diploid, they show the following thing. So the issue is if each of us agents is on his or her own, what we would do is all of us, we would invest our 1 apple at time 0 into this technology. And then at time 1, we learn whether we are the patient or impatient type. Now, if we are impatient, we instantly have to consume. So we liquidate this technology, but then tragically, this technology is only a storage technology between 0 and 1. So we only consume 1 apple if we are impatient. And if we're instead lucky and turn out to be patient, then we can stay invested in this technology a bit longer until time period 2, because we can consume in either period. And then we eat this very large apple. Now, the thing is, recall that at time 0, we are all symmetric. And each of us, it turns out in the optimum, we would like to ensure at time 0 against the risk of being impatient. Because the issue with being impatient is really that between time 0 and 1, this technology only functions as a storage technology. So optimally, what Diamond and Diploid show is we all would like to write contracts with one another that assure us against the risk of being impatient. This is called risk sharing. So we all would like to pool our resources and write a contract so that if at time 1, I turn out to be impatient, I get optimally a little bit more than 1 apple. Yeah, I get slightly bit more. And then instead, an agent that turns out to be patient would get a little bit less than this very large apple. But we're all happy with this kind of contract because we are all agreeing on that this is optimal to write at time 0. Now, the issue with such a contract is also that, okay, so first of all, Diamond and Diploid show that banks can provide this kind of risk sharing. They simply pool all the apples at time 0 and invest for the agents in this technology. And then at time 1, if you turn out to be impatient, you walk to the bank and say, hey, I'm the impatient type. Please give me X1 star, a little bit more than 1. The problem is types are not verifiable. If I'm the patient type, I can also walk to the bank at time 1 and claim that I'm impatient. I can also demand these X1 star, and there's nothing the bank could do because the bank cannot distinguish between patient and impatient types. And so now if a lot of agents, recall we're given by this measure 1 of agents, if a lot of us claim to be the impatient type and demand X1 star, then a so-called bank run happens. The bank cannot pay out X1 star to all agents because this is a real contract. The technology pays in real terms, and this X1 star is in terms of apples written. Okay, and this is now where our paper comes in. We are going to exploit that the technology that basically transfers apple across time will stay in real terms, but contracts are offered in a nominal way. In terms of CBDC.
So I have a question. So
yes.
So I was getting confused by so the types of each agent are not something anyone can control. Those are just chosen at random according to these probabilities.
Yeah, that's random and exogenous.
But the agent itself is a strategic thinker.
Yeah.
And so because of that, let's call it degree of freedom, then a bank run can happen.
Yes. Okay, so the impatient types, they will always consume at time 1 because they don't live until time 2. But the patient types, they strategically decide whether to rather consume at time 1 and time 2. And they will make this decision based on whether they believe whether they get more apples at time 1 or at time 2.
Okay.
And the issue is a bit, if you're the patient type and you expect a run to happen, then no apples would be left at time 2. And then you rather go for the X1 star at time 1. And
so this model, I mean, it clearly has to do with what we're talking about here, but these people invented it for what reason? Like, what is it?
They invented it for the reason they showed that, for the 2 things, they show that banks basically can, offer these kind of optimal contracts. That's the one thing. But they show also, in order to offer the optimal contract, the X1 star, the bank has to be fragile. If the bank is stable, she has to offer an X1 equal to 1 or less. But then she cannot offer optimal risk sharing. So even in the optimal solution, the bank has to be fragile. So it's a dilemma. That's what they show.
Okay, thank you.
Mm-hmm. Okay, so we are building on this model. So it's great that you ask these questions because that's really important to understand. So we are building the model on top of this. But the contracts so now the bank is no longer a private bank, but it is a central bank and it becomes crucial in a moment from now. So the central bank offers nominal contracts. The nominal contract means denominated in euro, in dollars. But the technology in order to transfer apples across time stays the same. And it also remains that at time 0, a single agent is endowed with 1 apple to start with. Okay. So just for the timing, now it's the following way. So at time 0, the agent takes his apple and walks to the central bank and hands over the apple. And then the central bank says, great, in return for your apple, I give you the following contract. At time 1, you're going to learn what kind of type you are, whether you're patient or impatient. If you're the impatient type and you have to instantly consume, no problem. You can spend M units of CBDC balances. If you decide to not consume, fine as well, then you're going to spend your money at time 2, and you spend a little bit more even, namely M times 1 plus I, where I is the nominal interest rate that the central bank sets. Now, where does this come from? Or let me go on a little bit more here. So this is the perspective of the agent, what the contract allows the agent to do. And important is that the contract here is now denominated in terms of CBDC and not apples. From the perspective of the central bank, the following happens. So at time 0, all the agents walk to the central bank with their apples. They hand over the apple endowment. the central bank takes these apples and invests in the technology. So far, everything is as before. Now the difference is at time 1, the agents decide whether to spend their CBDC balances or not. The central bank observes how many agents would like to spend. Yeah, this is going to be an endogenous variable. It's going to be an equilibrium object. And so depending on how many agents want to spend, the central bank is now going to select the fraction of the technology that she would like to liquidate. And recall that the technology is in terms of apples, and spending behavior or the spending demand will be denominated in cash. So there's a wedge now occurring. Now, okay, so the central bank liquidates a strategic fraction of the technology and then sells this amount of apples to the spending agents, to the agents that optimally decide to spend at a price P1. And so this price becomes important in the next slide, but only then. So what happens with the remaining technology? The fraction 1 minus y has not been liquidated, so it remains invested in the technology. The technology earns the high return. So this is going to be the apple supply that is sold to the agents that decide to spend late at time 2. And so the spending agent at time 2, then they're going to face a price P2. And so these objects here, they are the price levels are important for a central bank because under the classic central bank objective, these price levels are supposed to stay stable under all circumstances. Okay, let's talk about an equilibrium condition, namely market clearing. So the market has to clear. This means the price level at time 1 has to adjust such that the total value of all apples that are sold equals the total amount of CBDCs that are spent. Yeah, so N is the fraction of agents that want to spend their CBDC balances. Each of them spends M. So this is a quantity denominated in, say, dollars. And so the price level P1 adjusts such that the value of this strategically liquidated technology equals the CBDCs that are spent at time 1. And similarly at time 2, the price level P2 has to change such that total CBDC spending equals the value of all apples that are supplied at time 2. Okay, so let's first solve these two equations. These are identities. Yeah, the price clears the market means that the prices adjust such that these equalities, they have to hold. And now let's solve these equalities for the price levels. So recall that traditionally, for a central bank, these price levels are supposed to remain stable. But how do these price levels not truly adjust? So recall that the spending behavior by the agents is strategic and is given by N. And the central bank observes this spending behavior and strategically liquidates a fraction of the technology. Yeah. So certainly what we see here is that the price level is also strategic. Yeah. And adjusts similar to a residuum if the central bank very freely liquidates Apple technology. And the same at time 2. Okay, so this is just to show you that these price levels, they are not set into stone. And this is interesting because here, this is really the perspective of the central bank. As a private bank, you would need to take these price levels as given. There's no way that a private bank could manipulate these price levels. But for the central bank, this is possible. Okay. Now, let's look at the perspective of the individual agent that decides whether to spend CBDC balances rather today than tomorrow. Okay, so the agent does not really care about the quantity of CBDCs that she spends or not. She really cares for the quantity of apples that CBDC balances can buy. And so what is this quantity now? So recall that assume that the agent would like to spend at time 1. She can spend her CBDC balances of M, and then you would need to divide by the price level. But where this is just intuitively equal to the strategically liquidated quantity of Apple technology divided by all agents that would like to spend CBDCs on apples. Yeah. So and similarly at time 2, the number of apples that a single agent can purchase with his value of CBDC at time 2 is just the remaining supply of apples divided by all the agents that decided to spend their CBDCs late. And the crucial insight is here really that we call it a patient agent who can decide whether to spend at time 1 or time 2. She really looks at how many apples do I get when I spend at time 1 versus how many apples will I receive when I spend at time 2. And so we see that on the one hand, an individual optimal decision depends on how many agents spend CBDC balances altogether, because recall that if there were only 3 apples in the market, and then there are 500 people that are interested in purchasing these apples, then none of us will get a lot of apples. That's just how it is. And this just shows that the central bank, by shortening artificially the apple supply, will be able to affect the price level here, but in particular also the individual allocation that an agent receives. So the central bank, by strategically choosing how much technology to liquidate, can affect the incentives of individual agents to spend rather early or late. I think, yeah, that's important. Okay, so let me define what it means, what an equilibrium is here. Okay, so the central bank at time 0 is going to commit to a policy, so to a money supply and a liquidation policy and an interest rate policy for every possible spending level that can arise. Yeah, and so a commitment means the central bank is really going to go through with her announced policy. So basically, she announced a function or 2 functions, I and Y, that say for every possible spending level, how much of the technology will the central bank liquidate, and what is the nominal interest rate that the central bank will pay on CBDC balances between time 1 and time 2. A commitment equilibrium now consists of aggregate spending behavior by the depositors, a money supply of CBDC, a policy Y, which is a function of the spending behavior, and an interest rate, which is also a function of spending behavior, and price levels, such that individually these spending decisions are optimal, taking as given the announced policy and the price levels. Then given an aggregate spending realization of the agents, the central bank observes the spending and then in fact goes through with her announced liquidation policy as a function of N. So she truly takes this N as given and observes the spending behavior and says, okay, I'm going to liquidate then the according amount of the technology. And we'll pay also an interest rate I of N. And last then, given the realization of spending behavior, the liquidated amount of the technology and nominal interest rates, the price levels are such that the market clears. Yeah. And so in this equilibrium definition is really crucial that the price levels here are going to flexibly adjust according to how many agents decide to spend and the liquidation policy and the nominal interest rate. So it generically does not impose that the prices have to stay fixed. So we do not impose the classic central bank goal here at this point in time. Okay. Then let me briefly talk about what it means that a bank run occurs. So a run occurs if also patient agents are spending. Yeah. So recall that the fraction of agents that are actually impatient is only lambda, but a patient agent can strategically decide to spend also at time 1. Okay, then, so given then that the central bank chooses a particular policy.
Why is, like, that's not, is it necessarily a problem if, I don't know, lambda plus 1 agents decide to spend? I mean, that's barely above what's expected. Like,
yes.
Why is it already a bank run?
Yeah, so we just need at this point a notion to pin down what it actually means, what a run is. And then in a moment, I will come to the point where, so recall that only lambda agents really have to spend early. And 1 minus lambda agents can strategically decide whether to spend early or not. And we will spend the next slides on looking under what conditions it is truly optimal for an agent, for a patient agent to spend early or not. But at this point in time, we just define a central bank run as the incident where also patient agents are spending their CBDC accounts early. Okay, So the question is now to characterize under what conditions is it in fact optimal for an individual agent to spend balances early or not. Okay, so the situation where only patient types are actually spending, so when n equals lambda, this is an equilibrium only if, so you would like to keep now the patient agents from spending their CBDC balances. And the way to do that is that conditional on only impatient guys spending, you need to take care that patient guys get more apples at time 2 than at time 1. That's it. And because the central bank commits to such, can basically commit to an according policy upfront, she can guarantee that this is the case. And vice versa, the question is, under what circumstances would a central bank run actually be in equilibrium? So under what conditions would it constitute optimal behavior by patient agents? And that is simply the case if all agents spend, patient or impatient, then if all agents get more apples at time 1 than they would receive at time 2, it's optimal to spend early. It's simple as that. And the question is now, how can the central bank avoid this to take place? And a clue is already given here, basically, because we just have to remember the real allocations, so the apples about which the agents care, has to do with, yes, how many agents demand to spend their CBDC balances, but also depends on the apple supply, which is controlled by the central bank here. Okay, so recall from Diamond and Diploid, we already know what the social optimum is, how much apples the central bank should optimally be able to promise impatient agents at time 1. Now the question is, how can the social optimum now be implemented by the central bank? The central bank implements the social optimum if conditional on only impatient guys spending, she has to liquidate sufficiently much apple technology such that she can basically give the optimal amount of apples to impatient agents. But vice versa, recall the central bank first observes aggregate spending behavior and only then needs to decide how many apples to liquidate. She now has to deter the patient guys from mimicking the impatient guys. And the way to do this is to set a liquidation policy such that if a patient agent tries to spend early, the central bank takes care that the agent regrets that. And the way to do this is to give a patient agent more apples at time 2 than at time 1. Now the implementation goes through the liquidation policy. So we just solve basically for the liquidation policy. We call a liquidation policy run deterring if conditional on many agent spending, so if more than the impatient types spend CBDC balances, the central bank artificially restricts the apple supply in the market. And the way to do this is simply to observe spending behavior and then artificially reduce the amount of technology that is liquidated. This is going to translate into very few apples that are provided at time 1, which means that even if all agents run on the central bank and spend, they're not be able to purchase a lot of apples in return. Instead, they have been better off waiting until time 2 and spending their balances there. And now interesting is, recall that we are looking at commitment equilibria. The central bank can announce such a policy, which is basically a schedule for every possible spending behavior between lambda and 1. She announces this upfront at time 0 before agents decide what to do at time 1. And this just means if the central bank implements such a run deterring or announces such a run deterring policy, then at time 1, if you learn that you're patient and you believe that the central bank is going to go through with her policy, then you know that you will be better off to not spend early, but rather spend at time 2 because you will get more apples. So this just means that this threat here is never implemented in equilibrium. Okay, so I will come now to the main result. And this basically is the first part of the trilemma. It just says that every policy which goes the following way. So if only impatient types are spending CBDC balances at time 1, the central bank is going to liquidate enough technology such that every agent receives the social optimum amount of apples. But if more than the impatient types are spending, so if n is larger lambda, then the central bank is going to liquidate not as much of the technology and will take care that you basically regret your spending decision if you're a patient guy. Such a policy deters central bank runs and implements the social optimum dominant strategies. Yeah, so runs do not occur and the social optimum always attains because only impatient guys will walk to the bank at time 1 to spend CBDC balances. The central bank liquidates the optimum amount, and then this is done. There's a flip side to that, namely if the central bank liquidates only a short or a small proportion of the investment, this is going to translate one-to-one to a very large high price level. Yeah. So this flip side is that the implementation of a run deterring policy requires that price levels are very large. Yeah. And in particular, they are flexible or potentially flexible in the spending behavior of the agents. Yeah. So this is the main result. This basically says the optimum is always implementable, runs do not occur, but the central bank has to threaten in a credible way with inflation. And only then will a run never occur, and then this inflation threat will not have to be executed in equilibrium.
I have a question. So maybe the direction's wrong, but why is liquidating, a certain amount of, like a large fraction of the technology going to cause the price to go up? I mean, usually liquidations drive prices down. I'm just confused about the direction.
Yes. Okay, so the intuition is you have to think about the wedge between, so the contract is denominated in dollars and the technology is denominated in apples. So the central bank does not restrict you from spending your CBDC accounts. Yeah? If a lot of agents decide to spend their CBDC units on apples, this is totally fine for the central bank. But what the central bank does is there may be 500 agents that want to spend their CBDC, and the central bank only offers 3 apples. This means that the equilibrium price, if you look at the market clearing equation, so if the left-hand side, if the supply of CBDC is huge and only meets a very short supply of apples, the price level will be gigantic. So the price of apples is going to be huge. Yeah. And intuitively, it just means that
that I understand, but so I thought that liquidating technology meant that the central bank is selling apples it owns in return for currency, which means that there are going to be more apples available to be sold. And the price go down then, not up?
Yes. So I think the liquidation policy has to adhere an upper bound. So it has to be sufficiently small, and then the price is large.
Okay, fine, sure.
Yeah, okay. I think you got it right. Okay. So I only have a few minutes left, so let me show you a couple of more results. So first of all, let me say that the result that I just shown you is good and bad news at the same time. But so in order to implement the social optimum and deter runs, the central bank will have to sacrifice price stability, but price stability is the classic goal of central banks. So what we are going to do in the remaining part of the paper, in my 3 minutes left or 2, we are going to impose an exogenous price stability objective. So we are basically now, of this trilemma, I've shown you that we can achieve these 2 goals by sacrificing the last one. We are now going to impose this 3rd goal, and we will see whether we can achieve optimal risk sharing or whether we can deter runs on the central bank. Okay, so we need a notion of price stability now. We would say that a central bank policy is stable at a goal P bar if the price level at time 1 remains at this constant goal P bar, no matter how many agents spend. So if maybe only impatient guys spend, maybe all of the agents are spending, the price level has to be at P bar, at this goal. This basically means that you pin down here the left-hand side. And so the central bank is going to observe spending behavior, takes the goal as given, and then liquidates accordingly. Okay, so what happens then? We have to change the equilibrium condition a little bit, but essentially what it means is that the liquidation policy of the central bank and also the nominal interest rate now adjust flexibly to spending behavior and the price level. Recall that in the other equilibrium definition, it was the other way around. There, the price level would adjust to the liquidation policy and the nominal interest rate. Okay, so just let me characterize what stable policies mean. We can show that a policy that is stable at time 1 at a gold P bar requires the central bank to liquidate in a constant proportion of the aggregate spending level, and requires this constant proportion for all possible spending levels. Yeah, so just think of a straight line. For all possible spending levels, the central bank liquidates this constant proportion. And now the issue is, however, that the central bank can never liquidate more than the entire technology. So there's a feasibility constraint. And this means that the real allocation at time 1, so the number of apples that you can promise an agent at time 1 under a P1 stable policy, is first of all constant under a P1 stable policy, but is also bounded from above by 1. Yeah, because you cannot liquidate more than 1 here. There's just one technology method. Okay, this is tragic because the social optimum requires an x1 star greater than 1. So we already here have the second part of the trilemma saying that if you want to implement a P1 stable policy, you will not attain the social optimum. Yeah, this is not possible here. But vice versa, it is the case that you will always be able to deter central bank runs. Why? Simply because the real allocation at time 1 is too small. Patient agents would not be interested in spending their CBDC balances at time 1 under a P1 stable policy. Yeah. So this is the second part of the trilemma. Under a P1 stable policy, runs do not occur, but you do not attain the social optimum. And now, in order the central bank would like to soften maybe the price stability requirement a little bit, because the central bank really would like to implement the social optimum. And so this is what we do now. So we say a partially P stable policy is a policy that keeps the price level stable for spending levels, or it requires the liquidation of the entire technology. Yeah. And so by partial stability, the central bank can has a little bit more flexibility in its liquidation policy. So she can basically implement steeper slopes. And a steeper slope is important because if only impatient guys are spending, the central bank here will be able to liquidate enough technology to supply the social optimum. But here's the flip side. There exists a range of possible spending levels for which the central bank has to liquidate the entire technology at time 1, meaning that for agents that spend late at time 2, there's no technology left. Yeah. So agents that then spend at time 2, they would receive 0 apples. But these agents are sophisticated, they're strategic. So they know at time 1, when they need to decide strategically whether to spend rather early or late, they know that conditional on many agents spending, there will be no apples left. So this just means that central bank runs are back on the table. Yeah, under a partially price stable central bank policy, there are now 2 equilibria. There's a good equilibrium in which no run occurs. So this means that spending behavior is low. In this no run equilibrium, in fact, the social optimum can be implemented and the price level is stable. But then there is a run equilibrium in which the social optimum is not implemented. Patient and impatient agents would like to spend at time 1 so early, and the price level goal is not attained. Okay, so I'm out of time. Let me wrap up. I've shown you a nominal banking model for a central bank. The central bank can always deliver on its nominal obligations simply because the central bank has the power to set the price level. Runs can nevertheless still happen because there will be runs on the price level that are possible. And what we basically show is that the central bank can never attain all her 3 objectives at the same time. So attaining price stability, offering the social optimum, and deterring runs will not be possible. Thank you so much.
Thank you, Linda. So I have a few more questions to ask. I don't know if Yun-Song or Jonathan have any questions in the meantime. Sorry for calling you out by name. So I do have one question. So this model of three time step model, I forget the names of the two.
Diamond and Diploid, I think, yeah.
So how imperfect is it? I mean, like, people make decisions all the time, right? Not just once and that's it. So how empirically validated is it for, I don't know, standard banks? Are there, more sophisticated models that people should want to study and try to kind of start from from your paper?
So let me say first, I think this is one of the big bank run papers. So it's people always call it the seminal paper on bank runs. I think it's a very important paper because it's very simplistic. It has thousands of extensions. So it's really in finance, everyone knows this model. And of course, it's very simplified in many kind of ways. So usually you would not think about the assets of being risk-free, like this returns paid for sure. There can be various time periods and so on. But what this paper really accomplishes is it shows in a very elegant way that banks can basically bring something to the table. They can offer these optimal risk-sharing contracts. And I think the original result that banks have to be fragile in order to offer the optimum, that's very elegant. Well, it's it's an important banking model. I think the simplistic model is very I think it's always good to aim at simplistic things and then extend from there. That's much yeah, that's my personal opinion. I don't know, but it's a very important banking model.
So another question is, so when you have these central banks considering CBDCs, I presume there are some teams somewhere discussing, should we do this, should we do that, kind of trying to make some considerations. Do you have a sense of, are these people talking about technological solutions? Are they talking about policy solutions? What are they, how are they spending their thinking cycles? Like, for instance, knowing about this paper, would them help them a lot? Or maybe they have policies dictated by politics, maybe, or philosophy rather than theory. Some parts of the economy have maybe more to do with philosophy than theorems, right? You just pick like a political part of the spectrum, and then there's economic kind of setup to go with it. Or are they like talking about technology and how to deploy these things in the real world? Have you spent any time talking to these people or investigating?
Yes. Yes. So let me start. So I'm not a central banker, but okay. So I think classically the research departments in central banks, they have different units. Some units that are interested in interest rate and monetary policy implications. Other departments that are interested in technology and payments and so on. Departments that are interested in competition aspects. And so the paper here only zooms in at one particular question, but central banks are debating. So they are certainly very critical in many kinds of ways. So they are really interested right now in all kinds of economic implications, how a central bank, how a CBDC could change the economy, affect the economy. So in a companion paper, what my co-authors and I are doing is we look at how the introduction of a CBDC changes the situation for private banks, because private banks also offer deposit contracts. And then private banks will have competition from central banks. And this can be dramatic if the central bank is for some reason perceived to be more stable or to provide safer contracts. Then potentially the central bank is going to absorb the deposits from the private banks, or in order to prevent that, private banks will have to raise their interest rates and so on. So this is one aspect that is that people talk about. There is the payment technology aspect, which I'm not fully knowledgeable about, but this is certainly discussed. So how a CBDC can enable or make cross-border payments more efficient, how these settlements can work exactly in detail. But this I'm not in these cross-border payment systems. So, but yeah, so I think this is very highly debated in these institutions that I mentioned at the beginning of the presentation, critically and potentially also favorably. Yeah. But let me say that, so in these central banks, there are a lot of researchers, in fact, working. So a lot of economists, and I think they are, I believe that they know my research. Because this project is associated with the ECB. So it's the Lamfalussy project. And so I think they know the project, but yeah.
Okay, thank you. It was actually very interesting. Okay, so yeah, thank you so much, Ina, for putting together this talk. And yeah, workshop continues for another 2 days with 4 talks a day. And I look forward to see you all there. All right, so we're done for the day. Bye, everybody.
Thank you. Thank you, Alessandro. Bye-bye.